All right, guys, welcome to another Wednesday episode of the Educated Homebuyer Live, where Josh and I answer your mortgage and real estate questions, update you on the economy, everything that's happening in the world of real estate and mortgage. While Josh types, while I talk to you guys, just to
you can hear
in the
it.
background.
You can
Absolutely,
hear it.
we can hear it. But anyway, guys, welcome back. We are happy that you're here. As always, Josh and I are here to essentially help you guys become educated home buyers. So Josh, where shall we start this evening? What's happened this week? What's new and exciting in the world?
It doesn't seem like anything is new or exciting. It's more of the same, meandering through the wilderness.
The wilderness of mortgage and real estate, or
The wilderness of mortgage and real estate. We can go into politics if you like. It gets people really excited. You can offend at least 50% of the people with any comment you make.
Let's not go there this evening, but let's keep things on track and moving forward. Not a lot of questions in there at the moment, and we typically don't start with questions anyway. We like to get into the data. We like to look at inventory, what's happening in that world of, supply, demand, all of that good stuff. And so with that, we are going to start where we normally do. And Josh, that is looking at inventory, which is clearly not going to come up here. So we're going to do it the old school way.
The magic button didn't work for us tonight?
The magic button's having trouble. So this week we're sitting at 513,000 single family homes on the market nationwide. That's a 1.1% increase over last week, 24% increase from a year ago, and 102% increase from 2 years ago. Year over year inventory growth is one of the factors that points to future price weakness, but we are still well below anything that's going to lead us to declining prices, at least at the moment. Orange County sitting at 2,040 homes. Huntington Beach sitting at 140. Weekly inventory change went from 507, like I said, up 1.1% to 512,759. Our all-time bottom was back in 2022 at 240. Our inventory peak for last year, I believe, was in May at 569,000. So we're sitting at 513. Still got 2 months before that same peak of last year. So we're likely to see inventory climb. Are we going to go above that peak? At the moment, I think the answer is probably yes, because I think rates are going to stay high enough to allow inventory to grow, but we will see as time progresses on. New listings data. So 60,000 new listings added to inventory this week, plus another 17,000 immediate sales. So total new sellers were 14% more than in 2023. Let's see here. Until the new listings data gets back to 80,000 per week in March, like the gray lines in the new listings chart, we'll be stuck at 4 to 4.5 million home sales rate. So I think latest existing home sales rate, Josh had us just over 4 million sales annually on a seasonally adjusted basis. There were predictions at the beginning of the year seeing 4.5, 4.7, depending on who you were following.
And aggressive folks were like 4.7, 4.8.
And we were in kind of the camp, somewhere under 4.5, I believe. At least that's my prediction. I don't remember yours exactly.
I thought 4.5. I think you were at like 4.3, and I was at about 4.4, 4.5. So apparently my aggressiveness is proving to be inaccurate.
We will see. Time will tell. Let's see here. What's our next chart? The median home list price. So median price of single family homes in the U.S. is now $439,000. That's up 1.2% from a year ago. Median price of newly listed this week is $424. That's up nicely for the week and 4% more than a year ago. So Mike Simonson says, again, if mortgage rates jump, we'll see the price of new listings peak in May and probably start declining. So going to be interesting to see what happens when mortgage rates, if and when mortgage rates actually decline. Josh, what if they stay here forever? What if this is the new? What if this is the new?
Well, here, let's talk about that for a second, Jeb, because there are two conflicting things. The data, where the jobs market is going, where inflation is likely to shake out, even though we've been trending sideways here recently, tells us that rates will be much lower than where they are right now. The giant wild card is excessive government debt and spending, which we're heading into election season. So let's talk about the politics, Jeb. The politicians of all stripes would like to spend your money. We get comments
My
from
money?
people saying, well, your money, my money, everyone's money, everyone who pays taxes. And if you have enough income to buy a home or be a homeowner, you have enough income to get taxed. So yes, our money, Jeb, the royal our money, they are trying to spend it, because when you hear about all of these programs, no matter what it is, everything can be couched in a, well, we should do this. Well, if you have an excess of money at home, anything that your heart tells you you should do, you can feel free to do. We don't have that. We have a $34 trillion deficit that we're adding an extra $1 trillion to every 100 days or so, because as a country, we've decided we should do a lot of things that we cannot afford. So that is the wild card. At a certain point,
YOLO.
YOLO. We as a country do have no FOMO, because we just YOLO all day, every day. Put it on the card, bro. I haven't hit my limit. And that's the reality. And at a certain point, you guys have all heard the saying bond vigilantes. The buyers in the bond market, whether it be foreign governments, whether it be hedge funds, whoever it is, eventually says, I don't like this. There's too much debt out there. So when you add $1 trillion, literally every 100 days, we're putting $1 trillion on the government's credit card. Eventually, the lender that's loaning you that money is either going to jack your terms through the roof or stop loaning you money. But our politicians don't want to make the hard choices. And we elect them. And it depends on which team jersey you wear. There are certain things that you think are great things to spend the money we don't have on. And hard choices will get enforced on us at some point, but we're not there yet.
All right, there's Josh. He's stepping off his soapbox now. You just see him.
It's not a soapbox, Jeb. It is the reality of what is going to happen with bonds. So if we're here talking about housing and interest rates, keep what you think should happen separate from it. That is what is happening.
Well, there you go. Pending sales and prices: 67,000 new contracts for single-family homes. Started this week compared to only 62,000 a year ago. That translates to maybe 4.3 million home sales rate, not seasonally adjusted, 8% more than a year ago, still 15% fewer than March of 2022. Price reductions are, slowly ticking up still by like 0.1%, still really, really low. Currently sitting at 31.4%. It actually, most of the U.S. housing market data came in healthy this week. Maybe the 1 weak point is price reductions. Mike says, he says now 31.4% of homes on the market have taken a price cut from the original list price. That's up 50 basis points from last week. So again, we talk about normal being 30 to 33%. So we're still within the lower end of that range, which takes us, Josh, to housing inventory, the listing count in the United States. So yeah, go ahead.
What I was going to say is our friends at Housing Wire, and you probably have the answer to this, keep changing their charts. And they had this one in, and theirs is better than this because Fred is only through January, and this number is ticking up. And the reason why I wanted to put this in here, and I was hoping that the Altos chart was there, is those two red lines. We have a declining trend line. We had less and less peaks in inventory for a number of years. So people are freaking out going, oh my God, inventory is up 40% year over year. Like that was the title of the show 2 weeks ago, Jeb, and people were asking, what are you talking about? Oh, that's terrible. That's crazy. This is a normalization. So do we have this long-term downtrend where less and less inventory comes onto the market as we're normalizing? So meaning, do we stop somewhere around 800, 850, 900,000 in inventory? Or do we get all the way up to that 1.2, 1.3 in total inventory? Because either one of those are healthy. They are fine. Part of the reason why we're seeing unexpectedly high year-over-year home price appreciation with rates this high is that low level of inventory. So you see these screaming headlines that, hey, this is a terrible thing. This is a good thing that it is normalizing. Part of our ultra high home prices and low affordability is because we had those 2, 3, 4 years with really low inventory. But Jeb, do you know why they switched away from that?
I don't. I know they started using more of Altos's actual charts versus Housing Wire doing their own version of it. So I know these charts are still out there. We can probably find them, but at the moment, they're not putting that one out there. So, but go back, Josh. I think it's important
Okay.
because people earlier, we said 513,000 active single family homes in the United States. You look at this chart and it's showing a number 650-ish or so. If you're looking at that, and people often say, and Fred, people look at Fred charts and say, why are the numbers different? You're lying. You're telling, you're manipulating data, whatever. The reality is people count things differently. Like the National Association of Realtors, for example, when they count inventory, they're counting pending. They're counting properties that are actively under contract in addition to active home sales. So their numbers are over 1 million sometimes because of the way they're counting those numbers. In addition to that, I can't say how Fred does theirs exactly, but sometimes they're adding additional types of properties in here to those numbers, so the numbers reflect differently. When we give you the numbers at the top end of the show, we're always using the same data. So the number that is trending is always accurate from that same source, versus getting different sources. You're going to get a little bit of variation in what those numbers look like.
And that is realtor.com data. So it's important to remember that Fred, they don't crunch the numbers. They aggregate the data and they put it in a cool format where we or you or anyone else can go through and pull it apart. Jeb, this one was fun for me, and you're going to see why here in a second. So Fannie and Freddie's single family serious delinquency rate decreased. So you've seen over the last 2, 3, 4 months, we've seen the screaming headlines that delinquencies skyrocket. Well, this month we could say, hey, they're down. Everything's great. But if you look, Freddie Mac and Fannie Mae both report this information. So Freddie was down to 0.54 from 0.55. So essentially an imperceptible difference. Fannie is down 0.53 from 0.54, also 0.01% difference. Just like the skyrocketing rates the last few months were nothing, you can see on this chart, we are at record levels of low delinquency. It dropped month over month, but essentially unchanged. So just be careful to actually read the numbers when you see the crazy headlines.
No,
that's not a
I
crazy
just want
headline.
the headline.
That's not a crazy headline. That's Bill McBride, who we're going to keep talking about him coming on the podcast until he actually does it for us. Speaking of home price changes, Jeb, Case-Shiller came out with numbers this week. We also had FHFA numbers. So Case-Shiller saying 6% year over year. I think one of these, which was it, Jeb? FHFA or Case-Shiller was down month over month, which is not unsurprising for this time of year. But the year over year was up 6%. This is FHFA. They're up 6.1%. Mm-hmm. We talk about long-term historical averages about 4%. This is 150% of what we would expect as normal home price appreciation, despite the fact that we're coming off a couple of years of the highest appreciation that we've ever seen. So not necessarily a good thing. We want, expect, and need this to moderate. So when we go back and we're looking at those listings, Jeb, we want more listings on the market, so home price appreciation slows. And as wages increase and hopefully someday rates decrease, we see affordability return and improve to the market. Of course, Jeb, I would get this wonderful chart, and it doesn't say the source on it, but I believe this is the FHFA data. It's not, because it's 5.8.
That's Case-Shiller.
That's
the CoreLogic. CoreLogic.
Okay.
Yeah.
So Case-Shiller was up 5.8. So one was up 5.8, the other was 6.1. And importantly, the forecast, they're forecasting no growth month over month, but 2.6 over the next year. We always talk about all real estate is local. Do you care what that national number is? You really shouldn't. Look at this chart. They post different cities, different regional areas. You can break this down. You need to know what the market is doing in your area. As we've talked about for the last several weeks, the northeast quadrant of the U.S. is seeing much more appreciation. The South, Texas, Louisiana especially, and then that Idaho, Montana, where we had seen huge price appreciation, not doing as well. They're all gaining, but not gaining nearly as much. So the national data is important. If you are a renter now and you're wanting to become a home buyer, but it's not a reality yet, you're probably well aware of this. This was interesting to me, Jeb, that the vacancy rates are the highest there throughout the South. I don't know if that's, it didn't make sense to me, because that's where a lot of people are moving. That's where affordability is better. Maybe it's just because they're building more throughout the South than other parts of the country. But that was an interesting one from that perspective. We talked last week, Jeb, about jobs and how jobs impacts income. Income will dictate a lot of things going forward. I looked at this and it related it back. Last year, Jeb, we did an episode of the podcast on moving to a lower cost of living area. And many people said, hey, that would be great, but I'll make half as much as I make in a lower cost of living area than I do where I am currently. This shows you over the last 100 years how less true that is, whether that's remote working. I don't know all of the causes, but much less of a divergence in areas. And I think, Jeb, we looked at, or maybe I looked at it for a video that I was doing the other week when I was looking up area median incomes. Like some of these low cost of living areas, like Omaha. I always talk about Omaha. It's who's our guy, our quarterback that likes to say Omaha. But anyways,
Manning.
Manning. So you look at Omaha. Omaha has higher area median income than many areas with home prices twice that expensive. So if you are open to relocating, there are places around the country, in the country as a whole in general, where you can make more than what you think relative to where you are and can find a home that you can afford. This one, Jeb, I just wanted to throw in there just because in the same news feed here, CNBC has a guest on that says, would not be surprised if we got 0 or 1 rate cut this year. The very next one says 3 rate cuts are plausible due to strong productivity. And then the last one there, Reuters is just reporting that U.S. yields fall as rate cut expectations grow. So we talk and we like to project and see what the data is. But going back to that just cloud of confusion right now, there's people with strong opinions and data-backed opinions either way right now. In terms of what's happened with interest rates, Jeb, we look at the 10-year most every week just because most people don't understand how the mortgage-backed securities work. But I thought this was helpful. The red box there shows that we have a 2-day chart. So on this, you want mortgage-backed security prices to go up because that means yields or interest rates go down. So you look at that and you go, hey, the last 2 days have been pretty darn good. But then when we look at the last 3 months, basically since that nice fourth quarter run down in interest rates, every new high that we have had in prices, and remember, we want a higher price because that's lower interest rates, every new peak has been lower. So we're sitting here at the highest we've been in, a couple weeks? But we shouldn't expect to break through this. We would hope to break through it. Technically, that would be a good sign if we went up over the last peak there and had a new high. But until we see that, the last 2 days improvement is to be taken with a grain of salt. So what does that actually mean for you if you're out there looking to borrow? Optimal Blue is reporting 6.76 on a 30-year fixed. Mortgage News Daily is at 6.91. Both of those can be true and accurate. My guess would be that Optimal Blue probably has more points factored into that for people that are locking those interest rates. And many of you are looking at FHA, VA, government stuff. So Mortgage News Daily at about 6.4 on government and Optimal Blue at about 6.614. So a little bit of improvement over the week, but essentially where we have been for the last several weeks.
All right, there you have it, guys. If you found any value in that at all, do us a favor, hit the thumbs up. If you're not subscribed to the channel and you've been hiding under a rock for the last 3 years, subscribe to the channel. It helps out. This past week, we covered buyer broker agreements, commissions, the changes with the National Association of Realtors, how that might affect you as a buyer. If you haven't listened to it, let us know. Or if you have listened to it, let us know what you think about that. And if you haven't listened to it and you're in the market to buy a home, you need to pay attention to it because there's a high likelihood it's going to have some impact on you one way or another. So head it over to the Educated Home Buyer podcast and check that out. And for anybody that's listening, wanted to see the charts that we just talked about, there will be a link in the description below where we'll have those charts linked if you want to go and go through the data and see exactly what Josh and I were referring to when we were chatting earlier. So now is the part of the show where you guys are actually interested. It's your questions. This is where we're going to answer them live here. This information, this entire episode will be on the Educated Home Buyer podcast on Friday. If you like to listen to it, in an audio format without, ads and all of that YouTube puts in there, that's the best way to get it. But now we're going to dive into it. So Big G, Josh, starts it off by saying, if I own my house with no mortgage and I sell it and put all of the money into another home for me to live in, I still have to pay capital gains taxes. Big G, we addressed this, bro, last week. Are you just putting the same question back in here? Did you bail on the answer and didn't hear the answer?
Maybe no, he was watching during happy hour, Jeb.
Probably making bets on the NCAA tournament before it started last week. I get it. Let's answer the question. Yes, if you're a single individual you get up to $250,000 in exemptions, if you will, plus whatever your stepped up basis is with improvements and other things. As a married couple, you get up to $500,000 in exemption. Anything above and beyond that you can't deduct because of, you just made too much money on your home, you will be taxed on that, whether or not you put it all into another property or you don't. That is the way that capital exemption rule works now. Back in the day, if you rolled it all into a new property, then there was no taxes. That's not how it works. So understand that. Talk to a CPA. We're not CPAs. We're not tax professionals. Talk to somebody that actually does it full time, and they can tell you exactly what you're looking at there from a tax standpoint. Got a lot of our regulars in here, Josh. Miss Taylor saying hello. We got V Quez, new one to the show, I believe, but saying good evening. And Matthew, loving the content. Matthew's also a regular here. Elay has a question about buyer broker agreements here. I'm trying to get it on the screen so I can actually see it because of the way this thing reports. Josh, can you read that so I can get this situated?
Absolutely. Here? Jeb, if a buyer signs a buyer broker agreement in one state, does the agreement apply to all states? Thinking of areas like New York, New Jersey, or DC, Maryland, Virginia, where they might be looking to buy in multiple areas at the same time. Is the buyer broker exclusive only for the state listed on the contract?
I can't say 100%, but my guess is it's exclusive to that state, because most cases you're not going to have an agent that can represent you in multiple states unless it's all close together. They're like, well, I guess in your case, New York, New Jersey, and DC, Maryland, Virginia. Maybe there's agents that do all three, but typically speaking, like California, the contract is for California. So if you were to buy in Arizona or Nevada or somewhere else, then essentially that agreement would not apply. At least that's how I perceive it. But what I would do is ask an agent in your area that, that you're thinking of working with, how that works out there. But typically speaking, states have their own agreements and they don't transfer over state lines, in my understanding. So hopefully that is helpful. All right, Josh. Brent is asking says, love the content. Inventory here in Kentucky has grown somewhat, but affordable houses in good areas are still going under contract in 1 to 2 days. Hopefully it improves over time. So guys, this is another market that Josh and I aren't really familiar with at all, but it just shows you what's actually happening in some of these markets. There are markets where inventory is increasing. This is one of them, but yet it's still hard to find affordable homes in areas that people want to live. And when they do come on the market, they sell quickly. So last week we had somebody in New Hampshire. So it's not just here in California, guys.
And Jeb, an important point in that is he said that affordable houses in good areas still going under contract in 1 to 2 days. We talk about all real estate being local, and who cares if you're buying in Kentucky, what's happening in Texas or California or Washington? You care what's happening in your area. But you also, if you're buying a $300,000 house, you probably don't care what's happening to $2 million houses in your area. And what we're seeing across the country is exactly that. Well-priced, affordable entry-level homes in good areas in decent condition is where most of the competition is. So just be aware of your market and your market segment that you're looking at.
All right. Mona is asking, who is affording these houses? So Josh and I actually talked about that today in today's recording of the Educated Homebuyer podcast. It'll drop next Tuesday. We talk about corporations buying homes, the concern out there that a lot of people have. We address it head on to tell you exactly what's happening out there. But because you asked that question and I have my notes in front of me from today's episode, I can tell you who's affording these homes right now. In the latest existing home sales report, that came out not that long ago, about a week ago or so. First-time home buyers, we're 26% of the market share right now. So who's affording these? 26% of the people buying these are first-time home buyers. Now, again, real estate's local. It might be more concentrated in one market than another, but the reality is 1/4 of homes is going to somebody that has never owned a home before. 33% of the transactions out there in the market are all cash. It's a big number, guys. So 1/3 of homes have some sort of cash offer. Like I told you guys last week, got a property here in Huntington Beach at roughly 1.6. 4 of the 5 offers that came in were cash offers. There's a lot of cash out there in the market. Investors made up 21% of the sales in this month was in February, because the data is about a month old. So 21% of the homes, investor. Now, understand, when we say investor, we're not talking big corporations. We're talking anybody that's buying a second home for an investment. Could be Josh buying an investment property. Could be me. Could be you guys buying an investment property. That is 21% of the market. Distressed sales, the thing that everybody's waiting on, less than 3%. So very small percentage of the population. And everything else, I know those numbers don't add up to 100%, just so you know. Some of them are move-up buyers. Some of them are buyers downsizing. There's a mix of other people.
Some investors pay cash.
Exactly. So there's some of that overlaps, but understand, gives you a general idea of what's happening out there.
And Jeb, I think it's helpful to give some context to a couple of those things. Why are cash buyers a higher proportion of the market? First of all, we have less volume. We have 25% less sales than a few years. Who is impacted? The people that need to finance them is impacted more than the person that can pay cash. So there may not be more cash transactions. They are a larger percentage of the market. We talked about on the show today when we recorded that investors, a lot of the investor activity that we're seeing, they're rotating up, or they're combining. I've got two properties with loans on them. I can pay them off and buy one trophy property free and clear, and they become a cash buyer and an investor. So there's a lot of that stuff going on. We're saying, who's affording this? So normally we would be 30, 31, 32% first-time buyers. So 26 is not way down from that. We still have first-time buyers, but those other segments are doing more of the buying. And part of the reason why prices keep escalating is there is not a lot of supply for those first-time buyers and other buyers who are capable of qualifying. So I know for a lot of people, they look at that and they go, that's crazy. How do I do that? Well, it's not impossible, and there are folks out there who want and need to buy and can qualify and afford.
And with that, I also point this out in the podcast, but first-time home buyers being 26%, Josh mentioned it, that number is normally in the low 30s. So it's like, it's off, but it's not off significantly. Investors make up 21% of the market. It's typically 17, 18%. So yes, it's a little bit higher, but it's not like double, triple what it normally is. Just something for context. We often say the word context. Understand the underlying conditions, just when you're talking about these numbers. Josh from Kylie saying, if I have a 130-day late payment in the last 12 months, how likely is that to kick my application out of DU and get a refer for a manual underwrite? VA buyer, 675 credit score, current DTI 17%.
So a couple things to know. Fannie and Freddie are much bigger sticklers on this. So it would be more likely to kick you out. And so the long answer is we don't have a matrix. There's not something you can look up and say what's going to happen. It's a black box, all of the automated underwriting systems. In terms of VA above 640 with 130-day late, highly unlikely to force you down to a manual downgrade. The good news with VA, lots of lenders will do the manual underwrite. Shouldn't be a big impact to you either way. There are some differences if you get pushed to a manual, that you're likely going to be going to a much lower maximum debt to income ratio. So I also, Jeb, this is the thing I like to point out. We get folks here all the time saying, hey, here's my debt to income ratio. They're first time buyers wanting to enter the market. Say, here's my debt to income ratio. So I'm assuming what Kylie's saying here is a 17% is her current debts add up to 17% of her DTI. If we're talking about with the new home factored in, a 675 FICO and a 17 DTI is always going to pass. I would say with near certainty that you're going to get an automated approval. But if we're saying car payment, student loans, credit cards are 17%, and then we add 30% in there for the house, and we're at 47%, it gets a little less likely. But if we're under a 50 debt to income on a VA and we have a 675 FICO, highly unlikely that one late will kick you out. Same thing, pretty similar with FHA. It could be an issue for you on a conventional, but you'd have to run it to find out.
All right, good stuff. Let's see here. Couple questions are Big G's coming in with another question. Says, are sell contingent on another sale a thing of the past? Absolutely not. Very common, especially in the market at the moment. I've had two recently. In fact, I've got one in escrow right now. We were able to sell his home contingent on buying another home. In fact, we got the up leg under contract before we actually got his home under contract, believe it or not. So they still exist. They're common. They just need to be structured right. They're not ideal. In an ideal world, you have your home on the market, you're ready to go, you're in escrow, and then you find the replacement home. But not everything works perfectly, and it definitely can be done. Just make sure you have somebody that understands how to do them, how they're the addendums and everything that's associated with it are done correctly, so that you're not selling your house or forced to sell your house because you didn't check the right box or do something that you should have done. So hopefully that is helpful. Mina says, my builder's preferred lender wants to lock me now. 6 months. Says fee includes a one-time float down 30 days before close.
Do it.
Should this be stated on the application, or is this standard?
Well, let me ask you a question, Mina. If you have a float down, why would you not want to lock? If I'm saying, hey, I'm going to give you a 6-month lock, and that represents your worst case, and one time through that process, you'll have the opportunity to float down to the market.
But
I just don't see any reason why you would.
No, but she's asking you, should that lock be somewhere in writing, that float down? Like, should that
a loan cannot be locked without getting you a locked loan estimate? So your lock
should the float down be in writing somewhere?
Absolutely.
The one-time float down.
I would say yes. If you don't have it in writing, then they can come back and go, oh yeah, we didn't say that.
Okay. So I think that's what she asked at the end there. Or at some point in there, says fee includes, should this be stated on the application, or is this standard? It's not standard. It definitely should be in writing somewhere, but yeah, I will leave it at that. So,
and what I would say, Mina, I think you're here in California, but where are you at? And is it a big national builder that you're buying from? If you are buying from a big national builder and they have their own mortgage company, they don't want to risk bad publicity, because you can go to the local news and yell and say these things people did terrible things, and then no one wants to buy their houses. So I don't think it's a huge risk, but Jeb's 100% correct. And you are correct to be asking, get everything in writing, so we don't have anything to debate in the future.
All right, good stuff. Stephen, I'm going to get to Steven rather. I have a lot that's been on the market for 120 days. Should I lower the price? Hard to say. With land is different. In your market, how quickly does land typically sell? In the area that your land is listed, how quickly do things sell? I mean, there's a lot of things go in there. I would say in our market, if a lot came up, depending on the lot that it is, it could sell in a matter of days, or it could take months, depending on what it is, how it's priced, et cetera. So, I say trust your realtor in what they believe it to be listed at, and take that recommendation. That's the best advice I can give you, unfortunately. There was another one here, Josh, that was a good question. Elay says, if buying an older home, let's say built before 1924, what are the big ticket items to look for in an inspection? I would say the big ticket items for most houses, even ones built or before, after 1924, foundation on something 1924 is probably important. It's probably a raised foundation. You want to get under the house, make sure nothing crazy going on there. But focus on the items that are the most costly. Focus on things like the roof. Focus on things like HVAC, the furnace, water heater, big ticket type items. Things that are going to cost you a lot of money to fix or repair is where I would spend most of my time. If the bones of the house are good, the foundation, the exterior, the wall, everything is, it's not leaning, anything crazy. You say, Jeb, that doesn't happen. It does happen. I've got videos of crazy houses where they're leaning. But nevertheless, focus, once that's all done, cosmetic stuff can be replaced. Less of a concern. Focus on the things that are going to cost you money coming out of pocket to deal with, would be my recommendation. Josh, we had this earlier. It's one of those questions that's difficult to answer. I haven't clicked on it yet because of that, but Derek's asking about rates. When are they going to go back to normal levels? I think at the moment we're at normal levels, historically speaking, to some degree, but when are they going to go down?
Actually, Jeb, I will take exception to that. If you take out the 70s and 80s, you go back 100 years, average is probably low to mid 5. So we are above that. But what did we have in the 70s and early 80s? We had higher than normal or typical rates of inflation. And
we had drugs.
We still have that. Apparently some of us still do, Jeb. So there's a couple of premises there in the question. When, meaning there is a point that they will, and then normal, what is normal? We talked early in the show, it is very hard to say because the government for the last 20 years has been borrowing a lot of money, and during COVID just went nuts, and then apparently thinks that there is no limit to what will happen in terms of inflation. And, one of the things, Jeb, we haven't talked about this in a while. We had a couple of guests that loved pointing out accurately during COVID that you can't increase the money supply this much and not create inflation. And we talked about, okay, money supply is going up massively, but velocity was down. Well, then the lockdowns are over, velocity goes up, and we have this increase in money supply. So we saw inflation. Well, last year we had seen a decrease in money supply. I don't know if I should throw in that chart for next week. Money supply has leveled off at a newer, much higher level. One of the lunatics that's been screaming about a housing crash for the last 4 years actually posted this on TikTok and got traction with it about 6 months ago, that we have never seen a decrease year over year in money supply this large other than the Great Depression. Get ready, folks. And you look at it and you go, okay, cool. Yes, it is true that we had the biggest year over year decrease, but we are still at a much higher level than trend would ever tell you. Until you get back to normal, the only way that doesn't lead to inflation is in terms of velocity going down. And we've talked about this before. We're not going to bore you guys with velocity of money, but velocity is slowing and kind of normalizing to what we've seen over the last 10, 15 years, but money supply is still elevated. And so answering this question is complex. If I could answer it, maybe I would be up for being the next Fed chief instead of being on YouTube talking about it.
Yeah, just stick to YouTube, bro. You don't want to be the Fed chief. Mina,
they get a nice government pension.
Mina, $5 super chat coming in strong. This is a perfect segue, Josh, into talking about a community that I created on School for the Educated Home Buyer, or we created rather. That you guys can be a part of if you're interested. There is a fee that's going to associate with it. It's going to be different than what we do here. It's going to be a community. A lot of you guys are already part of the community, but this is going to be different. We're going to do separate videos that we're only going to be posting in there that talk about different things off subject that have to do with housing. We're going to do weekly updates. We're going to do a lot to really bring value to the group. If you're interested in that, actually, let us know in the chat. And if so, I'll drop a link there if people are interested in checking it out. It's fresh. I mean, literally off the press last night, where this is just getting going, but it's something that wasn't going to bring it to you guys tonight, but Josh, you did kind of segue. You didn't segue in there. Mina comes in every single week and gives us $5. And it would actually be less expensive for Mina to be part of the community than do that. So
give her a cheaper subscription.
Yes, that's where this all came from. Yeah.
How about this though, Jeb? You and I have been batting around. What is of value? What do people want to see in there? How do we best use our time each day, bringing you guys the things that you want to see in that community? So in the comments there, if you have something that you would like to see on a regular basis, occasionally, anything that you don't feel is available out there to you as a buyer, a prospective buyer, a homeowner that you would want to know about the housing market, let us know and we'll do our best to make sure we include it in there.
All right. Good stuff. I was, prior to coming here, I was at the soccer field with my youngest child, and my eyes, dude, coming in here now, I'm like blind over here. My eyes are itching so bad. I have a feeling it's from that. You guys don't care about that, but I care because I can barely see at the moment, and therefore I thought I would mention it. Right. That said, Josh, I digress and we move on. Muhammad is asking, I have 7 investment properties under my personal name. How do I pull some of the equity I built to purchase more assets? So Josh, fairly easy way to do it. A refinance, but Josh, what am I missing?
Well, his follow-up question is they're all at 30-year fixed. I'm assuming you didn't buy them all in the last 18 months. So they're probably at 30-year fixed rates, much lower than what current rates are. So the unasked question in there is, how can I affordably at a reasonable rate access that? You can get a second mortgage, you can refinance, take cash out, you can sell one and rotate into another property. There's no magic out there. Those are the options for investors with portfolios like this. If they're all geographically centrally located, if you're in an area that has community banks, there are community banks that will do blanket loans that will cover them all. and let you leverage it a little bit differently, possibly get them off of your personal credit report in case you're wanting to use Fannie Freddie financing above and beyond the 10 loan limit. So there's not a good or easier or excellent answer there. You're going to have to borrow, and the borrowing costs are high. It's just a question of, is a first or a second make sense? And once you do that borrowing, does the investment itself make sense?
All right, good stuff. Eli is asking me, who is the more dominant player in high school, Ingram or Stackhouse? If I'm being completely honest, I don't even remember when Stackhouse played. I mean, I was there and whatever. I don't remember how dominant he was. I was young, so it was like, but it's funny that you asked that, because I was thinking about it the other day for some reason. I was thinking, who was the most dominant player in the NBA from Kinston, and I have to believe it was Stackhouse. Like, he had a hell of a career. I mean, he was in the NBA for 15 years or something.
I'm giving it to Ingram.
Ingram?
I'll pull some advanced stats, and we'll do a comparison.
You should pull some stats. It was a different time when Stackhouse played versus now, for sure. But yeah, both great players. And two more kids coming out of there soon, I think. Potentially headed to the NBA. Crazy enough. Yeah. Anyway, let's see here, Josh. We've got Quentin saying, I made $150,000 in Phoenix, double the median household income for area, and cannot afford a home and still invest 20% of my income into retirement. How do you see this as a sustainable market? So, Josh,
can I go first? Because
yeah.
I mean, Quentin, I don't think you're serious. I don't think this is a serious question. You're saying a market is not sustainable unless someone making double the median can buy and afford to save 20% of their income. The long-term savings rate in the US is about 8.5%. That has been trending down for a long time. It's about 3.8%. So if you're hitting 7 or 10% of your savings, you are well ahead of everyone else. These are both investments. Investing in your home, which is fixing the cost of the shelter over your head, and an expectation that it will keep pace with the rate of inflation, which will be positive and not negative with deflation going forward. And the leveraged aspect of that will make you money while giving you a hedge against the inflation in rent costs. So there's just so many false premises here. I don't think you're serious with that. I almost feel it's a humble brag of saying, hey, I make a lot of money for my market and I save a lot of money and I want to do both. Sometimes you can't do both. You have to sacrifice somewhere. And so the question, how do you see this as a sustainable market? It's a sustainable market because there are enough people who are able and willing, you may be able but not willing, but able and willing to buy the limited supply of homes coming on the market. And there's nothing on the horizon that's going to change significantly and appreciably that supply of homes.
All right, good stuff. Josh, we did have one person come in and say more information about VA loans, especially with refinancing, assumable loans for future live streams. Mina says saving for home loan programs, first-time home buyers, rent versus purchase, being a landlord. These are all things that we can talk about. And these are all things we will talk about in there. So good stuff. Josh, go ahead. You're gonna say something?
I need to apologize. Quentin followed up and he promises it's not a loaded question. So if I was being a jerk, I apologize. I'm just saying
you were.
Everyone would love to buy a house and save 20% of their income. Sometimes we've got to make a decision. And the reality is, Quentin, if you buy that house now and you have to cut back to 10% or 8%, the reality is you fixed your housing cost in 3, 4, 5 years when you're making 170, 180, 200. Someone like yourself who is conservative, who wants to save, will build that savings rate back up.
Well, I mean, here you're in Phoenix where the median is whatever. Take California, for example. What people need to make here, and you want to save 20% on top of it, it's crazy. You weren't even able to do that in like 2015, 2010, much less 2024. I mean, it's again, we all want it, but it's in some markets, most markets, it's not realistic to have that. Budget with twins. Today on the radio, there was a commercial, Josh, stating that interest for mortgage refinance was at 5%, but 7% APR. Why are they saying two different rates?
Do we want to talk about what APR is?
Briefly, it's
almost worthless. The government created it to try and help you compare two loans. Other things being equal, which often they aren't, including the calculation itself being accurate or not, the closer the APR is to the note rate, the more reasonable it is. When you see a 2% spread and it's not a government loan where you have a VA funding fee or an upfront mortgage insurance premium that gets counted as a prepaid finance charge and elevates that APR, if you're talking a conventional loan, they are charging you a literal shit ton to buy that rate down to 5%.
Yeah. I mean, basically the APR, how I used to explain it, is like the cost of getting the loan, whereas the interest rate is essentially what you're paying in a monthly payment, right? The problem with APR is that it's amortized over a 30-year period of time. Nobody has their loan for 30 years to start with. Most people don't anyhow in this day and age. So there's so many fallacies with that number to start with. But, you know, it always bugs me when people are like, hey, what's the APR on this? Like, I mean, you should pay attention to the APR because that's essentially what you're paying cost-wise for that loan, but it's not your monthly payment. So just make sure you're not getting screwed, and you're looking at box A on the loan estimate whenever you're refinancing or buying a house. I mean, that's essentially how you avoid big problems with the APR, simply put.
Jeb, we have a good comment here. It's not a question, but it actually starts a good discussion. The Panda Smuggler says DTI is skyrocketing. Maybe people aren't being smart. It's actually not skyrocketing. It skyrocketed and has leveled off because rates have been relatively flat for the last 12 to 18 months and prices have gone up, but not a ton. So you're not incorrect in saying they've skyrocketed because they did. We talk here on the show regularly, Jeb, that why are we not going to have a mass amount of defaults that leads to a bunch of distressed properties? It's because 40% of homes are free and clear. Of the 60% that are financed, they have ultra low 30-year fixed rates at low debt to income because they were bought before home prices appreciated. So if that is what makes those people safe and secure from that, if you've come later in the game, you didn't build up equity, you had a lower down payment versus someone who's been in their home for 5-10 years, you have a higher debt to income ratio, there is absolutely a greater risk of default. So there's no two ways about that. It's a very small portion of the market. And it comes back to the theme of the night. People keep saying, well, when are rates going to normalize? When are homes going to get more affordable? Many of those people, wisely or not wisely, said, I'm going to get in and do what I have to do, and I should be able to refinance at some point in the future. And hopefully that becomes true for them and their DTIs come down.
Well, here's the deal, Josh. Panda Smuggler wasn't listening to you because they were busy typing while you were answering the question. And my wife would say you can't talk and listen at the same time, Josh. So I know that's be true. And therefore you can answer the question, or you can just avoid it because they weren't listening to the first part of it. But they're asking, why do they call it rate buy downs instead of points?
Because no one knows what points are. Literally, I can tell you 1 out of 10 borrowers knows what points are. Even when you say a point is 1% of the loan amount and it's used to adjust the yield, they say, well, how much does one cost? It's a percent of the loan amount. Now I can charge you a half point, 3/4 of a point, 0.789 points, but it is a percentage of your loan amount. It's used as a yield adjuster. That goes over most people's heads. When I say, do you want to buy down your rate? Cool. What's the cost? It's $4,000. Yeah, I want to do that. So it's marketing, it's simplicity for borrowers to understand. It's all of the above. Inside, we are always talking about points. It's just a choice in terms of what you're doing in advertising and marketing and talking to clients.
All right. Lori is asking the question, have you seen any deals out there? So Josh and I get deals across our desk all the time, but they're typically for people that have cash and they're looking to rehab properties and fix and flip, that sort of thing. Those are where the quote unquote deals are. But if you're saying a home that's been on the market, have I seen any deals? No, I have not. There's very little inventory in our markets out here in Orange County area. Therefore, most homes are selling, where they should be, if not higher than I think they should be in some cases. So no, not a lot of deals happening in SoCal. Josh, if a buyer qualifies for a conventional loan, paying less than 33% of monthly income toward housing expenses, is it still possible to put too much of net worth into a home purchase? It's always possible, but
yeah,
you got to do
you want
right.
to remain liquid. Like I'll have people that will come and they'll say they don't make a lot of money, but they want to buy an $800,000 house and they have $400,000 or $500,000 in the bank. They go, I'm gonna put $500,000 down, finance $300 on my $800 house. Is that smart? Depends on how much of your net worth is in the house. If it's all 500,000 and you leave yourself with $10,000 in the bank, I'm not super comfortable with that, despite the fact that your housing payment is going to be much, much better. I will tell you, if we sat down here, Jeb, they would love this. We could do an analysis of our personal balance sheets. I am overweighted after the last increase in home prices towards home equity, and I'm not as liquid as I should be. And borrowing right now, not a reasonable thing. So rather than looking, hey, how do I acquire more real estate? The question I need to be asking and answering is, how do I save and invest more money so that I can be more liquid than what I am currently? So don't know if that directly answered the question, but hopefully that helps.
All my money goes to kids' sports. That's it. Like, I have no money. It's all gone. Everything is expensive and costs a ton. And my kids need new shoes every week. And there's jerseys and trips and everything else. So my balance sheet's really easy, Josh. Is just zero. There's nothing there. Let's see. Don't sell. Ironic that don't sell says I'm selling.
A question about selling
my 3-bedroom, 2-bath, and I just completed my 490 square foot attached ADU. Should I list now before the NAR rules change or wait? So my question, as we always ask, is sell and do what? Sell and buy something else? Sell and put the money into Bitcoin? Sell and, like, what are you doing? What are you trying to sell and do? Is the question at hand. Do I think things are going to change immediately as of the NAR rules go into effect? In some markets, it will be a bigger shift than others. Listen to the podcast that we put out today on the educated home buyer. It gives our thoughts on what's going to happen. There will be changes. It will take time for the real change to sink in. If you decide not to list a commission from the sell side, if you're not going to pay a buyer's agent, understand that can affect the way the demand on your property. As long as you know that, then list whenever you want. It's kind of a personal thing, but I would say demand is likely to pick up as interest rates go lower. But what does that mean? When is that going to happen? What is inventory going to look like then? Too many variables to really nail down at the moment.
I look at it, Jeb, and I say there's nothing about that settlement and going into effect in July, assuming it goes into effect the way that it has been agreed to and negotiated up front. Nothing about that is anything you can't do right now. You want to list and pay an agent 1% to list it, you can find an agent that will do that. You want to offer nothing to the other side, you can do that. Yeah. Anything that you will be able to do in July, you can do now. It's just you have more options now. After July, you're going to have less options. Even that's not really true, Jeb, because we've gone through this. There's ways to structure a transaction identical to the way it is now, except for the commission, the buyer's agent commission being listed in the MLS. Everything else you're going to be able to do. You just do it in a slightly different way. So I don't know that really anything is changing in terms of better or worse for a seller or limiting or changing it. You can do anything that you'll be able to do in July today.
As of right now, right? Nothing has been signed off on. We don't know if Department of Justice is going to require any additional things as part of the settlement or what have you, but that's where things stand as of now. So guys, we've been on 53 minutes and a lot of you guys have not done the simplest of things, which is hit the thumbs up. That helps us know that you guys actually appreciate the show and helps it push out to more people, which ultimately helps us accomplish our goal of educating home buyers. Josh, one thing, we haven't mentioned recently is that, we would love the opportunity to help you guys. If you're buying a home, you're looking for a mortgage, you're looking for a second opinion, looking for a real estate agent. If you're local, I can help you. Either way, I can get you in touch with one of my referral partners to guide you through that process. Josh is licensed in 18 states and would love to help you with the mortgage side of things. So that link right there will get you in touch with our team and get you moving in the right direction. And ultimately, again, you'll be in good hands. So that is our one ask for the show outside of the thumbs up and the likes and all that stuff. So Josh, we didn't get a high response. We got 0 response, in fact, on joining our community. So, maybe the community's dead before it ever starts. Maybe that we just saved like 3 hours of our time a week, which, might be a blessing in disguise. Even Willing didn't even offer to be part of it. That's surprising. Let's see here. Jack Hammer bought a condo in February of 2022, turned around in February 2024 and bought a 2,200 square foot home in Southern Virginia. Nervous, but both houses are still flying off the market here and prices are cooling, but still up 6%. So I think that's pretty much this. That's pretty norm for most markets out there at the moment. Outside of your highly, the markets that appreciated this gangbusters, Austin and some of those markets, most markets are still up and still doing fairly well since the pandemic. So, but it's always good to hear about different markets. Virginia is one of those markets that's got strong demand, just, good job security, good location for, jobs and just travel and everything else. So good spot to be. All right.
So Jeb, you're getting sucked in. Mina says she'll join. Big G joining also. Maddie, of course, is in. So it just you got at least 3 people committed there. We just got to build off of that.
Build off the list, huh? All right. Well, we'll see. We'll see what happens here. All right. Let's see, guys. We're 55 minutes in. We don't have a lot of questions, Josh. Where do we take it from here? If there's no questions, what are we doing?
Jeb, I have a question for you, and I may sound dumb for asking this in public. It is YouTube related, not real estate related. When these people show up on your channel and they make a comment that says promo SM, what is this comment spam? What does it mean? Do you know?
It's just, there's so much spam out there, dude. So many spam bots. I don't know that it means
the same thing. It's not a link. It says promo SM, and
yeah.
I'll get it. And you're like, what? And what are you doing?
Yeah, no, just dude, the amount of spam that comes across is just ridiculous on YouTube. I've just given up. I just don't even respond anymore. I just let whatever happens happen.
Shouldn't we have bots that are good enough to just eviscerate all of the spam?
That is the complaint. There's a lot of people. Marcus Brownlee was one, came out and made a special video on it, and just, people impersonating him, just like so many different things and scamming and whatever else. And yet, a lot of it, I will say, is better than it was 6 months ago, but it still needs a lot of improvement. And with that, guys, don't trust things on YouTube. Like, if it sounds like a crazy comment, like it's too good to be true, it probably is, right? Reach out to somebody directly. Don't trust the comments. It's garbage for the most part. Anyway, I put that link in the description for anybody that's interested to go check out the educated home buyer community that's being started. Again, if you decide to join, let us know in there, who you are. We get to see you guys. I told all of you guys a couple weeks ago, hey, join, follow me on Instagram. And some of you did, some people did, but I'm always getting people following me. So I don't know who is who. So like, if you follow me, I don't even know. I don't know
say
what
hi.
your name is. Yeah. Like, comment, like DM me and say, I am so-and-so on, in the chat. And I'm like, oh, okay. Then I can reference, because I remember the names. I just don't know your real name. So, that's it. Josh, what are we doing here? Just feel like we're just meandering. We're treading water.
Willing asked 97 questions tonight, and we haven't answered any. So we're going to get one. It's a good one here. It says, what is the first thing you do if a borrower wants to do a VA loan? VA loan isn't really all that different, but the correct answer is get a certificate of eligibility. This would be shocking, but you have no idea how many people I have that reach out. We're at the 11th hour. We're supposed to close. And it turns out I'm not VA eligible for records got lost. I was a reservist and I didn't have enough service. It's a really easy thing to do. If you're a veteran, you can pull it off of eBenefits. I can log into WebLGY and have it in about 5 minutes, 90% plus of the time. And if we don't get it immediately, then we got to grab that DD-214, send it in, and usually within 3 to 5 days, they'll get it to us. So now we're about 99% of the time. Less than 1% of the time is there a problem, but it's like, do that, front load that, and make sure before you start going down that path, because there's no bailout for a VA loan. You go, go FHA. Well, now you got 0.55 mortgage insurance, and you have to put a 3.5% down payment. Not really comparable.
Nope. Agreed. Josue says, you guys have been super helpful in making my move to buy over rent. So we are very grateful, or I'm grateful. I can't speak on behalf of Josh. Josh will say his own 2 cents here to be part of the process, to provide any value that you've perceived from us. Again, that's the goal. So comments like that are always rewarding and why we do what we do. See, Josh didn't even
Absolutely.
comment, so clearly
No,
he
I'm just
didn't
saying.
care.
I was thinking the comments here. We get emails every day to the educated homebuyer email, and good questions, just comments. Hey, I was able to do this. This information was super helpful. Hey, can you clarify something you said? So yeah, we look forward to doing that in the school community where we can teach and answer questions and go deeper with you guys.
All right, good stuff. David, another regular viewer on here. A lot of regular viewers, as always, but just says a lot has been made about the rise in available inventory. But what is the rate relative to prior to the pandemic? Is the rate appreciable? So no, not really. No. So if we go back to the slides at the beginning of the show, one of the slides, if we put that back up there, Josh, let's see if we can do
I can
this
get it
here.
for you.
Is that back
When
on there?
in anything,
Go back
yeah.
to the very first slide.
What I would like to say, Jeb, before you go into the detail on this,
Yeah, right here.
the rate is abnormal,
Yeah.
but that's because we're coming from an exceptionally low level. So where we're at is nowhere near even approaching normal, which pre-pandemic was already below normal.
Yeah.
So
So if you look at this little chart here, it just says we're sitting at 513,000, single family homes nationwide active at the moment. If you go down to the bottom and read that last sentence for context, active listings in the same week back in 2015 was almost 1 million. So nearly 100% more than we are today. And I don't know if you remember 2015 or 2016. A lot of us don't. I don't really remember it like directly, but I can tell you it was a market that continued to move on. We weren't having these conversations. Well, we always had the conversations about crashes and everything else, but it was a more balanced market. You had homes, selling close to the asking price. Yeah, maybe there were some, reductions here and there, and homes selling under the asking price, some selling over, but just more normal market. But it hasn't been a true buyer's market since since 2009, maybe even early part of 2010. Ever since then, it's pretty much been a seller's market. So yeah, inventory is increasing. You got a long way before it gets back to normal levels. So hopefully that gives you a little context there, Josh. I can't. My thing's not working,
make it
so
go
you have to
away.
flip us.
All
Yeah,
right.
there we
That's
go.
our normal thing, though. Weren't we bigger than that? There, we're bigger than
Yeah, there we
that.
go. All right, guys. What we've been on the show? How long tonight, Josh? Just over an
Hour
hour.
two.
Hour and 2 minutes. We're going to end it here. Not a lot of questions. So just want to say thanks again for being here, for supporting the community, for allowing us to do what we do. We're grateful for that. If you need Josh or I, that referral link scrolling in the bottom will get you in touch with us. If you haven't done so already, hit the thumbs up, follow us on The Educated Home Buyer. Josh, final words.
Yeah, no final words for today. I got nothing.
All right. Minor. Adios, amigo.
Amigos.
Stole it.